This is 2035. Your friend Marcus just refinanced his home for the third time. His net worth? Up $280,000 just from appreciation. You're still renting. And you started with the exact same salary. The difference wasn't luck. It wasn't timing. It was a series of choices, and most of them happened between the ages of 27 and 33. This is that story. And the character in it is you. Level 1, the starting line. It's 2023. You're 28 years old. You make $62,000 a year, solidly average for your city. Your rent is $1,400 a month. You have $4,200 in savings and $23,000 in student debt. You are not broke. But you are not close to buying a house either. The median home price in your city is $385,000. A 20% down payment would be $77,000. Right now, that number feels like a different planet. Then your friend Priya sends a text to the group chat. She just put in an offer on a 3-bedroom in the suburbs. You heart react the message. Then you close your phone and feel something you can't quite name. Level 2, the social pressure builds. Over the next 6 months, 2 more friends close on homes. One in Phoenix. One in Charlotte. The group chat fills up with renovation photos, mortgage rate complaints, and HGTV jokes. At every dinner, at every birthday, there's a moment someone asks, "So when are you buying?" And you give the same answer: when the market cools down. When rates drop. When I have more saved up. These are not bad answers. But here's the honest truth, they're also not plans. They're reasons to wait without a finish line. And waiting without a plan is just drifting. Level 3, the first real decision. One evening you sit down and actually run the numbers for the first time. Not estimates, real numbers. Your take-home pay each month, $3,900. Rent, $1,400. Groceries, utilities, subscriptions, gas, roughly $900. Student loan minimum, $280. That leaves you $1,320. Of that, you've been saving maybe $400 a month, sometimes less. At $400 a month, reaching a $77,000 down payment takes 16 years. 16 years. But then you notice something. You spend about $340 a month on things that don't really matter to you: streaming services you forgot you had, 2 food deliveries a week, a gym membership you use maybe once a month. You don't need to cut everything. You just need to cut with purpose. So you do. You find $650 a month to put toward your house fund. That's not sacrifice, that's a decision. And right now, at level 3, it's the most important one you'll make. Level 4, the strategy shift. Here's where most people get stuck. They think buying a house is just a savings problem. Save enough, buy the house. But it's actually 3 problems stacked on top of each other: the down payment, the debt-to-income ratio, and the credit score. Your debt-to-income ratio right now is 36%. Most conventional lenders want it under 43%, but the better your rate, the lower they want it, ideally under 36%. That student loan is hurting you. Not critically. But it matters. Your credit score is 694. That's decent, but not great. At 694, you'll qualify for a mortgage, but you'll pay a higher interest rate than someone at 740 or above. On a $308,000 loan at 7.1% versus 6.6%, that difference costs you $96 more per month, and over 30 years, that's $34,560 extra. Just because of your credit score. So at level 4, you add 2 new goals alongside saving: get your credit score above 740, and knock down the student loan faster. You're not just saving anymore. You're building your buyer profile. Level 5, the boring middle. Month 7. Month 12. Month 18. Nothing dramatic is happening. You're not going viral. You're not getting a windfall. You're just depositing money, watching a number grow, and declining things you'd otherwise say yes to. Your savings account hits $15,000. Then $22,000. Your friends stop asking when you're buying. Priya posts photos of her kitchen remodel. Someone else puts in a pool. You feel the pull. The feeling that everyone is moving forward and you're standing still. This is level 5. The boring middle. And statistically, this is where most people make the mistake that resets everything. They get impatient, drain the house fund for something else, or just quietly give up the goal without admitting it. The only thing that gets you through level 5 is knowing it exists. The dip is not a sign you're doing it wrong. The dip is the process. Level 6, the life event. Month 22. Your car breaks down. The repair estimate, $3,200. You don't have a separate emergency fund, you were putting everything into the house fund. You have two options. Option A, take it from the house fund. Set back your timeline by 5 months. Option B, put it on a credit card. Protect the house fund but take on high-interest debt. Either choice feels wrong. That's the trap of having one financial goal. When life hits, and life always hits, you have nothing to absorb the blow with. You take option A. You pull $3,200 from the house fund. It stings. But you also make a new rule: before you contribute another dollar to the house fund, you build a $5,000 emergency buffer in a separate account. A house is a long-term goal. Life is happening right now. Your financial plan has to hold both. Visual cue: savings bar drops sharply. Then splits into 2 bars: emergency fund and house fund. Show both building simultaneously, even if slower. This is the mature version of the plan. Level 7, the leverage moment. Month 29. You get a raise. Not a huge one, $6,400 a year, which is about $430 more per month after taxes. Most people lifestyle inflate this immediately. New car payment. Better apartment. More subscriptions. You don't do that. You direct $350 of that $430 straight into your house fund. Your monthly contribution goes from $650 to $1,000. Your timeline just compressed by almost 2 years. Your savings are at $34,000. Your credit score crossed 740 last month. You got a notification and honestly, you felt something. Your student loan balance is down to $14,000. You're not at the finish line. But for the first time, it doesn't feel imaginary. Level 8, the research phase. Month 34. Your house fund hits $52,000. You're not at 20% yet, but you start doing something you should have done 6 months ago: you actually talk to a lender. Here's what you learn. You don't need 20% down. That's a myth most first-time buyers believe for years longer than they should. A conventional loan lets you put down as little as 5%. An FHA loan goes down to 3.5%. The trade-off is private mortgage insurance, PMI, which adds roughly $150 to $250 per month to your payment until you hit 20% equity. On a $385,000 home at 5% down, your loan is $365,750. At a 6.8% rate with PMI, your total monthly payment is approximately $2,640, principal, interest, taxes, insurance, and PMI. Your monthly take-home is now $4,330 after the raise. That payment is 61% of your take-home. That's too high. Financial guidelines suggest keeping housing under 28%. So you recalibrate. You look at homes in the $280,000 to $320,000 range. Less square footage. Different zip code. The goal is not the dream house, the goal is the first house. They are not the same thing. Level 9, the offer. Month 41. You find it. Not the perfect house, a solid house. 3 bedrooms. 1.5 baths. A backyard that needs work. Listed at $299,000 in a neighborhood that's been quietly appreciating for 3 years. Your house fund has $63,000. You plan to put down $60,000, about 20%, so you avoid PMI entirely. Your remaining $3,000 covers part of closing costs, which run between $6,000 and $9,000 on a loan this size. You negotiate the seller to cover $4,500 in closing costs. Standard ask in a buyer's market, and they accept. Your loan, $239,000 at 6.5%. You qualified for the better rate because your credit score is now 762. Monthly payment, $1,512 in principal and interest, plus roughly $310 for taxes and insurance. Total, $1,822 per month. Compared to your current rent of $1,550, which has gone up twice in 3 years, that's $272 more per month. But here's what's different, the $272 extra is buying you equity. The rent was buying someone else's. Level 10, the payoff. It is now 2030. You have owned your home for 4 years. Your home's value has increased to $341,000, a 14% appreciation in 4 years, which is conservative for your market. Your loan balance is down to $218,000. Your equity, $123,000. That number did not come from your paycheck. It came from time in the market. Your friends who bought in 2023? They're refinancing, renting out rooms, or using home equity lines to fund small businesses. Your friend Marcus, the one from the beginning, used his equity to put a down payment on a rental property. And you? You're not behind anymore. You're in the game. The last person in your friend group to buy a house is now building wealth the same way they are, 1 month at a time, 1 payment at a time. The difference between you in 2023 and you in 2030 is not intelligence. It's not income. It's not luck. It's the fact that you ran your numbers, made a plan, survived level 5, recovered from level 6, and kept going when it would have been easier to stop. Advice. Here is where you actually are right now. If you have less than $5,000 saved and your credit score is under 680, you're at level 1 or 2. Your job right now is not to find a house. It's to fix your credit and build your first $10,000. If you have $10,000 to $40,000 saved and a credit score above 700, you're in the level 4 to 6 range. You need a lender conversation, not more waiting. If you're above $40,000 saved with a credit score over 740, you're at level 7 or 8. You might be a lot closer to an offer than you think. Wherever you are, the worst thing you can do is stay vague about it. Pull your credit score tonight. Write down your actual savings number. Run the down payment math for your city. That is level 1. And level 1 is where every house in every neighborhood started. If you want to see exactly how to go from level 1 to a mortgage approval, step by step, month by month, that video is next.